Thank you for listening to this PYA webinar recast. PYA is pleased to offer this alternative way to access our thought leadership. This is a recording of a previously delivered webinar. The information is accurate as of the date of the original event. The video recording, slides, and associated material for this and all PYA webinars are available on our website at pyapc.com. This podcast is for educational purposes only. It is not intended to be used as legal advice or an official opinion.
Good morning, everyone, and welcome to Day 2 of PYA's third annual Summer CPE Symposium, Hot Topics in Healthcare. We're pleased to have you with us today, and for those of you who joined yesterday, welcome back. I'm Catherine Good, a leader in PYA's Audit and Assurance Department. PYA is happy to present these complimentary virtual learning opportunities for healthcare colleagues across the country. Throughout the Summer CPE Symposium, PYA thought leaders will present 4 sessions on trending topics and provide key takeaways and helpful tools for you and your organizations. Today's presentations are an annual accounting and auditing update, and this afternoon we'll be talking through a critical pathway information technology and how to prepare for a cyber disaster. With that, I'll hand it over to our moderator.
Thank you, Catherine. Our first presentation of the day is Annual Accounting and Auditing Update presented by Trevor Brown and Mimi Grachek, Senior Managers at PYA. And with that, I will hand it over to Trevor and Mimi.
Thank you. Good morning, everyone, and certainly wishing you a happy Friday. We're excited to be here for the next hour to cover some pertinent and hopefully relevant to you accounting and auditing related topics that are coming down the pipeline very soon. As was mentioned, my name is Trevor Brown. I'm here with Mimi Grachek. We are both CPAs and senior managers here at PYA in our audit and assurance practice. Both of us primarily work in the healthcare industry, serving not-for-profit and for-profit health systems and physician practices and anything tangential to healthcare, as well as governmental entities. We also perform numerous uniform guidance compliance audits for our clients. So we're going to be covering several topics that are related to accounting and auditing. We've divided up our agenda here into 4 main topics. And kind of organized into 4 sections. First, we're going to dive into some of the more recent FASB accounting updates and standards that are coming down the pipeline that may impact this year or the coming year for financial statements of your company. Next, Mimi will cover the governmental side of things as it relates to any new standards applicable to those of you reporting under GASB. Mimi will then shift to cover some new and important items related to single audits or uniform guidance audits, which I'm sure many on this call have had to deal with as the outflow of federal money into the healthcare industry has dramatically increased since 2020 and COVID-19. And then lastly, as time allows, we will cover some new standards that your auditors are actually having to implement as they assess you as their client and perform an audit, which will be the Auditing Standards Board update. We think that update will be important for you all as a client of an audit firm. So you'll be aware of what your auditors are being asked to do, some new things that you may hear, some new terms you may hear, some new things you may be asked to provide. So let's first dig through some of the more recent Financial Accounting Standards Board updates. So the first one we'll be covering is called ASU 2022-01, Derivatives and Hedging, Fair Value Hedging Portfolio Layer Method. This one was issued in March of 2022, and it is effective for non-public entities for years beginning after December 15th, 2023. So for calendar year ends, that's FY24. First, though, we need some background. The standard was actually issued to improve upon a previously issued accounting standard update, which was called 2712, which introduced the concept called the last of layer hedging method. For a closed portfolio of prepayable financial instruments, such as mortgages or mortgage-backed securities, the last of layer method would allow you to hedge the exposure to fair value changes due to interest rates for a portion of the portfolio not expected to be affected by prepayments or defaults. Over time, since that one was issued, stakeholders and readers of financial statements requested a number of improvements to that standard. Importantly, they wanted the last of layer method to be more broadly applicable. They thought it was too narrowly focused and was causing some entities to record it one way and others to record it another. So this new standard, ASU 2022-01, does that. It expands the last of layer method to apply to multiple hedged layers in a single portfolio, which means now they've changed the term to the portfolio layer method. It also expanded it to include non-prepayable financial assets. So ultimately, the standard really improves the optional hedge accounting model by better portraying economic results of you as the business, someone who's managing the business within the financial statements regarding hedges. We know many of our clients have hedge instruments, and so this is something that is potentially relevant to you as you're working on the accounting for hedges in this upcoming year. The next one we'll look into briefly here is ASU 2022-04. It's related to a term called supplier finance programs. It is effective for FY23 calendar year ends. So for fiscal years beginning after December 15th, 2022, it would be for your 2024 period. Firstly, though, I want to talk about what a supplier finance program is. So a supplier finance program, they also are known as SFPs for short. It's a type of financing arrangement that allows you as a buyer to offer your supplier early payment from a third party before an invoice is due. So this type of arrangement is entered into with a finance provider to establish the program. You would then purchase goods and services from a vendor and promise to pay at a later date, and then notify the finance provider of the confirmed invoices from the supplier or vendor. And then that finance provider would pay the supplier, and you would pay the finance provider back over time. That type of arrangement can improve cash flow, working capital, and it potentially even allows you to access lower rates from vendors since you would be offering earlier payment than normal. Prior to the issuance of this standard, there were no specific rules or disclosure requirements around this type of arrangement. And so there was really a lack of transparency of the existence of these programs in the financials themselves. Typically, they were just being presented as within the same line, kind of buried within accounts payable on your balance sheet. So this amendment, ASU 2022-04, requires buyers with SFPs to disclose sufficient information about the program so the reader understands the nature and activity of these programs within any given period. So it's quantitative and qualitative. Again, for calendar year ends, they would have already implemented most of this ASU, with the exception of what's called the roll forward of your SFPs, which is pictured here on the slide as an example. This is something that will be new to the calendar year 2024 for this standard. So you'd be required to show beginning balance and then changes during the year through invoices that were confirmed and invoices that were paid, and then an ending balance, and then qualitatively describe where that liability is within your balance sheet. So the next one relates to LIBOR rates and really to the sunset date of LIBOR rates. LIBOR rates were very commonly used in many different financial relationships. And at the time, there was an original standard, which is basically topic 848 as described here on the slide. ASU 2020-04 was issued by the UK Financial Conduct Authority, which is in charge of LIBOR, and they intended to stop compelling banks to submit to LIBOR after December 31st, 2021. Well, at the time, an ASU was created by FASB to create a sunset provision that extended that permitted essentially a sunset provision all the way through December 31st, 2022, which was 12 months after that expected cessation date for financial transactions associated with LIBOR. But things happened and things got slowed down and delayed, and ultimately the UK announced that The cessation date would be June 30th, 2023, which is, of course, after the original FASB ASU related to that sunset date. So this ASU extends that sunset date to December 31st, 2024. And so that's really what this standard is doing since LIBOR has gone away officially. All right, moving to the next one. The standard is related to leases and common control arrangements. It becomes effective for calendar year ends 2024. So topic 842, which is the big lease standard that we've all been dealing with now for several years. There were some stakeholders concerned about how to apply that lease standard to related party arrangements between entities under common control. So this standard does two things to address some common issues with that. The first is it actually gives a practical expedient for private companies or not-for-profit organizations that are not conduit bond obligors. The lease standard, this lease standard in the topic 842 lease standard, you're required to determine the enforceability of the terms and conditions of a lease and deciding if a lease exists and how to account for it. So this practical expedient will allow private companies in common control leases, so the leases between two commonly owned entities, to only have to rely on the written terms and conditions and not have to consider any enforceability of those terms and conditions. So if there are no written terms or conditions, the practical expedient cannot be used. So you would still be relying on the original topic 842 guidelines for that lease accounting. The second thing the standard does is it actually improves the accounting treatment for leasehold improvements within these common controlled leases. So again, in general, under topic 842, which was the big lease standard, that required leasehold improvements to be amortized over the shorter of the remaining term or the useful life of the improvement that was created. However, common control leases in practice have always had shorter terms. And so if you follow that rule, you're amortizing any leasehold improvement over the shorter of those two options, which ends up almost always being the shorter lease term. So what this standard does, ASU 2023-01, is that leasehold improvements will now be amortized over the useful life of the improvement, regardless of the term of the lease. And then it also requires remaining leasehold improvements when there's a adjustment to who actually controls the underlying asset. The transfer between entities would be recorded as an adjustment through equity or net assets. So the next one's 2023-05, business combinations, joint ventures. GAAP, believe it or not, has no specific authoritative guidance on how a joint venture upon formation should recognize and initially measure its assets and liabilities. So this standard requires that joint ventures apply a new basis of accounting upon formation, meaning it would recognize initially and measure the assets and liabilities at fair value, with some exceptions consistent with normal business combination guidance. It does not amend the definition of a joint venture or change how an investor in a joint venture would recognize, according to the equity method of their investment. It also will include some disclosure requirements that help a user of joint ventures financial statements understand the nature and the financial impact of the formation and the period it occurred. Again, the biggest change here is that there was no guidance on how a joint venture would record contributions into it at formation. So now all those contributions and all those liabilities assumed at formation are now going to be recorded at fair value. This will be in effect for any joint venture that's formed after January 1st, 2025, though you can apply it retrospectively if you have the correct and appropriate information to do so to any joint venture that gets created, beginning today or yesterday. So this next one is 2023-08, related to crypto. So this is kind of an example of FASB attempting to keep up with the changing and evolving financial times we're all living in, and creating essentially a new subtopic within the intangibles section of accounting literature specific to crypto assets. So this primarily addresses some specific presentation and disclosure items around this type of asset. So firstly, it states they need to be separately listed from intangible assets on the balance sheet. So crypto assets would have their own line item according to materiality, of course. And then any gains or losses from the remeasurement of crypto assets would be included in net income and also presented separately from how changes in the carrying amount of other intangible assets are recorded. It doesn't specify whether it needs to be classified as operating or non-operating. It just says it's kind of up to the facts and circumstances of whatever the entity considers to be operating. So there's somewhat of a choice there. There then are some enhanced disclosures that can get kind of detailed if you do hold any crypto assets. Requires you to disclose the name, cost basis, fair value, and the units held of each asset. And you also must disclose the method used to determine the cost basis, which is helping you compute the gains and losses each period. And then also there's a reconciliation and the aggregate activity of the opening and closing balances of your crypto assets. So this becomes effective for years beginning after December 15th, 2024. So there's still some time to address this one. And as crypto assets become more and more of a thing, this may be something that you all need to keep top of mind. So the next standard we're going to spend a few slides on, and you can see the first numbers in any FASB update imply the year that it was originally created. So 2016 seems well in the past. However, this is known as the current expected credit loss standard, or CECL, and it actually was issued in 2016, but was delayed multiple times, numerous times. But implementing it is finally here. So it was calendar years 2023 going forward for fiscal years, maybe June 30, 2024 year ends. This would be the first year you're doing it, and it does have vast implications and accounting impact to the financial institution industry, for instance, but it broadly applies to all entities that have patient accounts receivable, loan receivables, or debt securities that are classified as other than trading. So I want to spend a few slides thinking about how this would impact a hospital or health system or something in the healthcare industry space. It's definitely worth having a discussion for how it impacts healthcare. The first requirement is that assets have to be grouped together in like pools. And the groups you would then focus are on which ones are measured at amortized cost. So that means like which is accounted for at and adjusted for accrued interest or accretion or amortization of a premium or discount, or deferred fees and write-offs, or collection of cash, etc. So for each pool, you would consider the following: portfolio segmentation, loss estimate methodology, contractual terms, historical loss rates, current and future characteristics and forecasts. And the goal then is to determine the current expected credit loss for that pool of assets. So for a healthcare industry, what does this most likely impact? And of course, it's going to be if you have debt securities classified as other than trading and patient accounts receivable. So we will dive into maybe some aspects that affect those specific things. We'll focus first on debt securities. Here's some differences between old guidance, meaning pre-CECL, and new guidance, meaning what CECL implies. I wanted to compare and contrast some of these. So before CECL, these debt securities were evaluated for impairment individually. Now with CECL, as I mentioned, you have to group these securities in like pools. So similar assets with similar risk characteristics are going to be evaluated collectively, not individually. In the old method, a loss was recognized directly if the fair value was less than the carrying amount and there was intent to sell, or it was assumed that you would not be able to recover to the fair value before you were required to sell, or just recovery was not expected at all. Now in the CECL guidance, the expected credit loss, there's no consideration given to the intent or likelihood to sell. So it's really just based off of, will there be an expected loss? In the old guidance, the expected credit losses were based on a best estimate. So there was a lot of estimation involved, and there's still a lot of estimation involved in CECL, but they have enhanced the term remote risk of loss also needs to be considered. So previously that was not really considered. There was more of a likelihood of loss that was being considered in the old guidance. And then lastly here, in pre-CECL, after a loss was recognized, any improvements in expected cash flows were accreted into income over the life of the security. In the new guidance, favorable or unfavorable changes in expected cash flows are recognized immediately with an adjustment to the actual CECL allowance that had been set up. So that's some changes there that impact how you would account for other than trading debt securities. Some other things that impact patient receivables from a CECL perspective, I think healthcare was kind of uniquely positioned in handling this, because the way most of you probably do your accounts receivable allowance for contractuals is you are already grouping your like accounts into pools. Maybe it's by aging, maybe it's by payer group, and that's just an industry thing. And also there are already specific implicit and explicit price concessions that are part of the new revenue standard that we implemented many years ago. CECL will require you to evaluate if any portion of the implicit price concession or bad debt expenses should be recorded as an allowance for expected credit loss. So I want to talk for a few seconds here about the difference between what the implicit price concession is, which sounds like the credit loss, compared to what credit loss is according to CECL. So the implicit price concession, which you all are already recording, represents the decrease in the amount the provider is willing to collect for services provided implicitly. The credit loss represents the loss on amount provider believed they were entitled to, but not ultimately able to collect. So it's a little bit different in that regard. And then also implicit price concession changes in that credit loss would be recorded to an expense. I'm sorry, those are on the wrong table there. The changes in estimates are recorded to revenue. That's what the implicit price concession would be taking place. And then for the credit loss, the changes in the credit loss are recorded to an expense. So there is a difference in where that credit loss or implicit price concession would be recorded, either as a deduction in revenue and now going forward into an expense if it is determined that it is needed. There's going to be judgment in adopting this. Even in scenarios where you may reach the conclusion there's no significant financial impact to this, many of our clients have reached that conclusion. There's still, you still certainly want to make sure you're documenting the process of evaluating the CECL impact, and then also considering any enhanced disclosures that need to talk about where an allowance would be if one was recorded, and where, for instance, is the implicit price concession recorded versus a credit loss recorded. So those are some things you would maybe enhance your disclosures on, which is what many of our clients have done. So that takes us to polling question number 1.
Thank you so much. Polling question number 1 is, CECL had the following impact on my company's financials: a large impact, process, allowance, and disclosures; small impact, disclosures only; no impact at all, or I've never heard of CECL. And remember, you must fill out the polling question in order to receive CPE credit. Thank you so much for participating in our poll. Now I will hand it back over to Trevor and Mimi.
All right, thank you. I will kick it over to Mimi for the GASB section.
All righty. The first statement we're going to cover is statement number 100. This will address accounting changes and error corrections and how to handle those. This is effective for fiscal years beginning after June 15th, 2023. So if your fiscal year begins from July 1, 2023 on, then this is applicable. This statement defines the 3 accounting changes and the reporting implications for each type of change or error correction. In the previous guidance in Statement 62, there was a lot of confusion about differentiating accounting changes from corrections and understanding how the guidance differed for single year versus comparative financial statement presentations in regards to these accounting changes or corrections. So this statement isn't anything really new. It just helps to clarify that confusion and goes into detail into those definitions about what those accounting changes are and how to present them. So before we get into the meat and potatoes of the presentation, let's first define these accounting changes. The first type of change is an accounting principle change that's mentioned. This results from either a change from one generally accepted accounting principle to another generally accepted accounting principle that is justified on the basis that this newly adopted principle is preferable to the old. And it can also occur with the implementation of new authoritative accounting or financial reporting pronouncements. One thing to note on preferability here is that it should be based on the qualitative characteristics of financial reporting. So does it make the financial statements more understandable, more reliable, more relevant, more timely, more consistent, or more comparable? The second type of change addressed in this statement is an accounting estimate change. Accounting estimates are outputs determined based on inputs such as data, assumptions, and measurement methodologies, and a change in accounting estimate occurs when one or more of those inputs change. And changes to inputs can result from a change in circumstance, new information, or simply just more experience. It's important to note here that a change in accounting estimate that results from a change in measurement methodology that is used to determine that estimate should be preferable to that measurement methodology used before the change. And those qualitative characteristics that I mentioned above should be the basis for determining whether that new measurement methodology is preferable. Examples that we commonly see in this bucket are, a change in the method used to depreciate the capital assets or a change in valuation technique used to measure that fair value. So those are just 2 examples of kind of that nuance that falls into this category. And the third type of change addressed in this statement is an accounting entity change. And this can occur with many changes, such as the addition or removal of a fund that results from the movement of continuing operations within the primary government, including its blended component units. It can occur with a change in the fund's presentation as major to non-major, or vice versa. It can occur with the change of a component unit to the financial reporting entity or removal of a component unit from the financial reporting entity, with certain exceptions. And it can also occur with a change in a component unit's presentation as blended or discretely presented. And like all standards, there are certain exceptions that would not be considered a change to or within the financial reporting entity, such as acquisitions, mergers, or transfers of operations as defined by Statement 69 that would result in the addition or removal of a discretely presented component unit, or a component unit reported pursuant to Statement number 90, which is the majority equity interest statement. The last definition we'll go over here is that this statement defines an accounting error and a correction of that error. An error is due to a mathematical mistake, a mistake in the application of accounting principles, or an oversight or misuse of facts that existed at the time that the financial statements were issued about a condition that existed as of the financial statement date. So, sorry, was a little trigger happy there. Let me go back one slide. There we go. So now that we've clarified some definitions and gone through these 3 types of accounting changes, along with the definition for an error correction, what happens to the financial statement presentation when you have an accounting change or error correction? So changes in accounting principles and error corrections should be reported retroactively by restating those prior periods, if practical, unless otherwise noted by a newly adopted accounting pronouncement. So for single year presentation, a change in accounting principle or error should be reported retroactively by restating that beginning net position, fund balance, or fund net position as applicable for that cumulative effect. For comparative year presentations, a change in accounting principle or error should be reported retroactively by restating the financial statements for all prior periods presented, if practical. Additionally, each individual prior period presented should be restated to reflect the period-specific effects of applying that newly adopted accounting principle. If for some reason the restatement of all prior periods presented is not practical, the cumulative effect of any of applying that newly adopted accounting principle should be reported as a restatement of beginning net position, fund balance, or fund net position as applicable, as of the earliest period for which it is practical to apply that newly adopted accounting principle. There is a note disclosure requirement about this that we'll get into here in a minute, but going back to the reporting implications for accounting changes, the next change we're going to cover is an entity change. So for entity changes, changes to or within the financial reporting entity should be reported by adjusting those beginning balances of the current period. And lastly, for estimate changes, changes in accounting estimates should be reported prospectively by recognizing the change in the current period. This statement requires disclosure in the notes to the financial statements of descriptive information about accounting changes, either due to principal estimate or reporting entity changes, and error corrections such as their nature and reasoning. So this information should include the identification of the financial statement line items affected, the reasoning for the change and why it's preferable, and for comparative financial statements, if those prior periods presented are not restated because it's not practical to do so, the reason why that restatement is not practical must also be mentioned. And if that change is due to the implementation of a new pronouncement, the identification of that pronouncement should also be mentioned as well. In addition, if required, dependent on the type of accounting change, information about the quantitative effects on the beginning balances of each accounting change and error correction should be disclosed by reporting unit to reconcile those beginning balances as previously reported to the new beginning balances as restated. And furthermore, this statement also addresses that if you're required to have supplementary information in your financial statements like an MD&A, for those prior periods presented in the supplementary information that are earlier than those disclosed in the basic financial statements, that supplementary information should also be restated for error corrections if practical, but not for changes in accounting principles. So just note that difference there. All right, and on the next slide, this example was extracted from the GASB Statement Number 100 Implementation Guide, and this illustrates the tabular format for how to list certain accounting changes and error corrections if you have one. It's important to note that on this example, only the reporting units affected by these adjustments and restatements are shown. You can list all reporting units, but you're not required to do so with the statement update. So it might be more aesthetically pleasing just to list those reporting units that have a change. All right, the next statement we're going to move into is statement number 101. This is effective for fiscal years for governmental entities beginning after December 15th, 2023, with earlier application allowed. This will supersede GASB statement number 16. This statement defines what a compensated absence is and how the liability should be determined. The main goal of this statement is to unify the recognition and measurement model that hopefully results in a liability for compensated absences that more appropriately reflects when a government actually incurs an obligation. In addition, hopefully this model can be applied consistently to any type of compensated absence and hopefully eliminates the potential comparability issues between governments that offer different types of leave. So let's get into a definition. GASB defines compensated absence payments or settlements as those that could occur during employment or upon termination of employment. And they also recognize that generally these compensated absences don't have a set payment schedule. Many of these compensated absences you're probably well aware of, and you're probably already accounting for them consistent with GASB statement number 101. However, there are a few more nuances that are kind of clearly defined in this statement, and I'll pick out one of those in a second just to give you an example. So examples of compensated absences that you're familiar with include, vacation, sick leave, paid time off, holidays, parental leave, bereavement leave, and certain types of sabbatical leave. Sabbatical leave is one of those that I'm just going to give an example on how it's different with this statement. The sabbatical leave during which an employee is not required to perform any significant duties for the government, or unrestricted sabbatical leave as it's referred to in the statement. This is a compensated absence. However, sabbatical leave during which an employee is required to perform duties of a different nature, so for example, you're doing research instead of teaching, this is not a compensated absence. So if you have nuanced types of compensated absences like this, it's really important to make sure that you're consistent with the statement and read through and see if you're in compliance now or upcoming. So now that we've defined compensated absences, when should a liability be recognized? That is going to vary dependent on if the leave has been used or not. So for leave that has been used, a government should recognize a liability when the leave is used for the following two types of compensated absences. Leave that employees are able to take as needed without specific limits, or sometimes referred to as unlimited leave, and holiday leave that is needed with, holiday leave that is taken on a specific date, not at the discretion of employees. So think Christmas, MLK, not like a personal holiday. For leave that has been used, a liability should be recognized if these following criteria are met. If the leave is attributable to services already rendered, so AKA the employee has performed the services required to earn the leave accumulates, so it carries forward from one reporting period to another, and the leave is more likely than not to be used for time off or otherwise paid in cash or settled through non-cash means. As with most standards, there are exceptions to this guidance that we'll go over here. So when a leave is more likely than not to be settled through conversion to defined benefit post-employment benefits, the leave should be excluded from the liability, since the liability for those benefits are already recognized in accordance with statement 68, 73, or 75. So how is the liability calculated? For leave that's been used, it's typically the time used multiplied by the employee pay rate or other defined rate. For a leave that has not been used, you'll need to estimate that leave that is more likely than not to be used or otherwise paid. So in estimating the leave that is more likely than not to be used or otherwise paid or settled, a government should consider all relevant factors such as employment policies related to compensated absences and historical information about the use or payment of compensated absences. So for example, some employment policies have a use it or lose it rule, which means that employees need to use their leave within a certain period of time or it gets forfeited. Since this doesn't accumulate, it wouldn't be recognized. Another funky thing here is that if some or all of the leave is more likely than not to be paid at a rate that's different from the employee's pay rate at the time the payment's made, a government should measure the portion of that liability using that different pay rate. So for example, if leave is paid out upon termination of employment at 1/2 of an employee's pay rate at the time of payment, then you're going to want to use that 1/2 of the pay rate to determine that liability as of the date of the financial statements. Additionally, all salary related payments directly and incrementally associated with the leave, such as payroll taxes, employer contributions to defined contribution post-employment plans, these should be included in that liability calculation when the leave has not been used. Any changes to the measurement of the liability in future periods due to maybe like a change in pay rate, these should be recognized in the period of change. AKA, this is kind of a change in estimate that we just talked about, consistent with statement number 100. It's going to be in the current period recognized prospectively. So now that we've covered the financial statement recognition, let's discuss a few disclosures that must be made in the financial statements along with this. The statement here amends the prior guidance discussed in statement 34 surrounding the compensated absences. So for the purpose of the long-term liabilities disclosure required by 119B of statement 34, the government should either present the separate increases and decreases, or this is the amended part, a net increase or net decrease in its liability for compensated absences, rather than disclosing the gross annual increases and decreases separately. So a government that presents a net increase or net decrease should indicate that it is a net amount. In addition to this, the disclosure requirement in paragraph 119D of statement 34 is not required. It was historically required that governments disclose which governmental funds typically had been used to liquidate the compensated absence liability. And with this statement adoption, that's no longer the case. All right, so the last GASB statement we're going to cover here is statement 102. This is effective for governments with fiscal years beginning after June 15th, 2024, with earlier adoption allowed. So if your fiscal year end is June 30, 2025 or later. This statement focuses on the risk disclosures that may or may not underlie a governmental entity's financial statements. State and local governments, they face a variety of risks that could really negatively affect the service they provide or their ability to meet obligations as they come due. And although governments are required to disclose information about their exposure to some of these risks, essential information about other risks that are prevalent among state and local governments may not be routinely discussed because it's not explicitly required. For background, in the FASB codification topic 275, the risk and uncertainties topic, they do require non-governmental entities to disclose risk and uncertainties related to the nature of its operations, its use of estimates in the preparation of financial statements, and its current vulnerability due to certain concentrations and constraints. So because of the differences, the GASB really felt like there needed to be a statement of its own. Additionally, stakeholders had expressed a lot of concerns about the inconsistency with FASB and GASB. A lot of these were really amplified as of a result of the COVID-19 pandemic. So hopefully, the requirements of this statement aim to improve the financial reporting by providing users of governmental entity financial statements with essential information that's just not being provided as of now. All right, so this statement really doesn't define the term risk. That's defined by another GASB statement. However, it does imply that a risk is present if either a concentration or constraint exists that would result in a substantial negative impact to the entity. The statement defines both what constitutes a concentration and or constraint. So this statement defines a concentration as a lack of diversity related to an aspect of a significant inflow of resources or revenue, or outflow of resources or expense. And secondly, it defines a constraint as a limitation imposed on a government by an external party or by a formal action of the government's highest level of decision-making authority. So for example, one that is self-imposed can also expose the government to risk comparable to a risk resulting from a constraint imposed by an external party. The reason this is defined is because, concentrations and constraints can limit a government's ability to acquire resources or control spending. So let's get into some examples of what constraints and concentrations are. So constraints on a government's ability to acquire resources include, but are not limited to, those imposed by creditors, grantors, contributors, enabling legislation, statutory and constitutional limitations like the caps on imposition of property taxes or on the total amount of outstanding debt. Two detailed examples of constraints that might be most common in this situation that we see are a government's ability to control spending may be adversely affected by constraints on the types and amounts of costs that can be incurred. So for example, certain debt covenants may stipulate the level of spending relative to pledged revenue. Another example would be mandates to expend resources on a particular program that can diminish a government's spending flexibility and prohibit the government from reducing spending on that program, or requiring that the government contribute, additional resources of its own. The other bucket here, just to list out some examples, is concentrations, and those can vary internally with certain types of workforce agreements or revenue streams, and they can also exist externally with certain supplier concentrations. So it's very important that those who are preparing the financial statements fully know the governmental entity, because these concentrations and constraints can be overlooked or not known. In order to determine if the disclosure information surrounding certain concentrations and or constraints should be presented, the following three criteria need to be met. So a concentration or constraint must be known to the government prior to the issuance of the financial statements. The concentration or constraint makes the reporting unit vulnerable to the risk of negative substantial impact. And lastly, an event or events associated with that concentration or constraint that could cause a substantial impact have occurred, have begun to occur, or are more likely than not, our favorite terminology, to begin to occur within 12 months of the date the financial statements are issued. So not year-end date, but the actual date that the financial statements are issued. The good news is that if mitigating actions are taken by the government prior to the issuance of the financial statements, they cause any of the disclosure criteria not to be met. And none of the note disclosures that we'll go over here in a minute are required. However, if a government determines that those criteria for disclosure have been met for a concentration or constraint, it should disclose information in the notes to the financial statements in sufficient detail to really enable the users of the financial statements to understand that nature of the circumstance disclosed and the government's vulnerability to the risk of a negative substantial impact. It is important to note here that the board concluded that some risk associated with concentrations or constraints are isolated to individual reporting units that maybe have a risk profile that's different from the risk profile of the primary government. However, information about those risks is still essential to the user's analysis for making decisions and assessing accountability. So this disclosure should take into account those blended component units in addition to the primary component unit. So if those three criteria are met, then the notes of the financial statements should disclose the concentration or constraint, the event associated with the concentration or constraint, the actions taken by the government prior to the issuance of the financial statements, if any, and also listing out the substantial impact. The users need to know, is the entity going to be able to continue to provide services at the level that they've provided in the current reporting period? Are they going to be able to meet its obligations as they come due? So really have to get into the verbiage there to list out that impact and what it's going to be. Just some general disclosure principles as well. If the comparative financial statements are presented, the reporting requirements only apply to the financial statements of the current period. And if there are other areas in the financial statements that mention parts that can be combined with this note, you can combine this disclosure with other pieces of the pie in the financial statements to avoid unnecessary duplication and hopefully make it more aesthetically pleasing. So that takes us to polling question number 2.
Thank you so much. Polling question number 2 is, my company has restated a prior period due to an accounting change or error. There are 3 options: true, false, or I don't know. And remember, you must fill out the polling questions to receive CPE credit. Okay, thank you so much. I will hand it back over to our presenters.
Okay, so with our single audit update, for those of you who are in the healthcare industry, you're probably well aware of what a single audit is. But for those of you who don't know, a single audit is a compliance audit, or you may hear the term grant audit, and it's historically been required for entities that expend $750,000 or more in federal awards each year. This threshold has changed with the publication of the 2024 compliance supplement, and we'll get into those updates here on the next slide. A listing of these awards is put together on what's called a CFA by the entity, or a schedule of expenditures and federal awards. That CFA is then turned around and audited by your auditors and submitted to the Federal Audit Clearinghouse. As part of the audit process, your auditors are going to use what's called a compliance supplement to determine how to test the grants being reported. The latest compliance supplement was dated May 2024. The 2024 compliance supplement is effective for audits of fiscal years beginning after June 30, 2023. So if your year end is June 30, 2024 and later. Okay, getting into the updates with the 2024 compliance supplement. The good news is that the new single audit threshold has been raised to $1 million. Is effective for auditee fiscal years beginning on or after October 1st, 2024. So if your fiscal year end is September 30, 2025 and later. The hope is that this increase in single audit threshold, may potentially reduce the number of single audits. So you may find your entity not being required to have a single audit. Just depends. There was also an increase in equipment threshold. Hopefully this might reduce the administrative requirements for those of you related to those lesser valued items. There was an increase in the de minimis indirect rate, which hopefully potentially, increases, a lot of you may be using that rate as an easier process. There was lots of simplification in the language and program requirements that we won't get into, but I did want to make you aware that there were changes to over 110 individual federal programs included in Part 4 of the compliance supplement. So it's really important to pay close attention to those grants and see if you have any changes year over year. So there are numerous parts of the compliance supplement listed here. I just want to skim over them with you. I know we're cutting it close on time, but I think it's important that you know what all is in the compliance supplement. Part 2 lists out assistance listing numbers for each federal grant and lists out which of the 12 tests are applicable for each grant in a matrix format. This matrix format will change every year. So some years you may have different tests perform on the same grants that you've expended money on in prior years. There were more changes to this matrix than in prior years. Some programs have been added if they're new, and so some programs were deleted if they were not frequently audited, and we'll come back to that in just a second. Part 3 lists out the objectives for each of the 12 tests in overview. It's important to note that the special tests and provisions requirement is unique to each federal grant, so you've got to go to Part 4 to determine ways to actually test that compliance requirement in Part 4. Part 5 lists the clusters of programs to be tested together, and Part 6 focuses on the internal control over compliance requirements. There are 2 other parts here that I want to make you aware of that are not listed. Part 7 provides guidance to auditors in identifying the compliance requirements and designing tests of compliance for requirements of programs not included in the supplement. So going back to Part 2, if you had a program that was potentially deleted out, Part 7 will be where your auditors go to determine how to test that. And then Part 8 lists miscellaneous information that could be helpful, such as key program contacts for programs that you've received or expended funding for, a listing of programs deemed higher risk that will impact the selection of federal awards audited, a listing of changes from the prior year compliance supplement, and other audit advisories. So Part 8 is where you can go to see a listing of those changes year over year, which is really important. So on the next slide here, just to wrap up our single audit update, for those of you who are in the single audit process, you're well aware of Assistance Listing 93.498, which is the Provider Fund Relief or ARP Assistance Listing. You might be in process or just finished being audited for periods 4 and 5 and gearing up for periods 6 and 7 audits. The main change to this program with the 2024 compliance supplement to make you all aware of is that this is no longer designated as a high risk program. So this is potentially good news. However, the Coronavirus State and Local Fiscal Recovery Funds, which is Assistance Listing 21.027, this does still continue to be listed as high risk, and that program did have a few changes to the compliance requirements that you want to take a look at. Just a few last cutoff dates that I want to make you all aware of. For fiscal year ends as of June 30, 2024 through fiscal year ends as of December 30, 2024, recipients should report in the CFA the expenditures and lost revenues from both periods 6 and 7 PRF reports. And then for fiscal year ends as of December 31st, 2024 through fiscal year ends as of June 29th, 2025, recipients should report in the CFA the expenditures and lost revenues from period 7 PRF reports. So with that, I think that takes us into our third polling question.
Yes, thank you so much. The last polling question is, my company receives a single audit every year, in some years, never, or I'm not sure. Thank you so much. I'll hand it back over to our presenters.
Thank you, Mimi. So that brings us to our final section here, and it's the Auditing Standards Board update. And we really just wanted to highlight here briefly some auditing standards that are coming down the pipeline. We spend a lot of time going through standards and updates and accounting rules that may impacting you all as a client of an audit firm. But what you may or may not know is that there's an entire organization that provides similar guidance to your audit firm and what they should be doing when they're performing an audit. That's the Auditing Standards Board. It's a senior committee of the AICPA, oversees quality control for audit and attest engagements. And recently there's been a whole slew of new, they're called SASs, SAS, the statements on auditing standards. They've been issued in order to enhance quality and stay up to date on new items that may be impacting our clients. Again, these are things that your auditor will now be having to do, but we thought it would be helpful to just briefly mention what these are so that you would be aware as the client of an audit firm of potentially new questions that you are being asked or new things you're being provided, or just aware of what your auditor is now having to consider when they're performing your audit. We certainly won't have time to get through all of the slides we've included here, but there is an attachment on this webinar that will cover in more detail some of the slides we don't get to if you're interested. I'll probably stick on this slide. This is a summary of the different SASs that we were gonna go through, and just to really cover what each of these is impacting. The first two, 142 and 143, those went into effect this past year for calendar year ends, and there were some enhanced documentation requirements about audit evidence and about how auditors are auditing accounting estimates. So you may have noticed your auditors may have been asking for different type of evidence during the audit, or they have maybe asked more questions about the process and how you all are performing at different accounting estimates, for instance, the contractual allowance or malpractice or things like that. So there's enhanced guidelines that we're having to follow for those type of things. So just be ready to answer additional questions there. 144, that one is related to you all as a client of an audit firm, you all having a maybe a valuation specialist or an actuary that you're using you get a report every year and you rely on that to help prepare an estimate that's impacting the financial statements. We, as your auditor, have some more enhanced guidelines on the work we are to do now over the use of that specialist, whether it's getting more information about the inputs that were used, the methodology, the estimates involved, which may mean that it would be beneficial to you as a client of an audit firm to involve your auditor in discussions early on in the use of using a management specialist, because they may be able to further align rather than waiting till audit, the time of the audit to be having these discussions. 145 is related to understanding the entity and its environment and assessing risk of material in this statement. That one will be in effect coming up this year for calendar year ends, and so, or for June 30 year ends and for calendar year ends. But it is essentially, there's not really new information here. It's just more documentation about the doing the enhanced risk assessment. So as a client of an audit firm, it will be beneficial for you all to have documented specific internal controls and procedures in the area of your risk assessment. How are you all internally doing a risk assessment? In fact, your auditors may be asking for your internally prepared risk assessment if you don't already have one. And another aspect that's involved here is enhanced documentation required about the IT environment that's impacting the different areas of the financial statement. So SAS 147 has some more information about how, if it's a first-year client, what the new auditor is supposed to be doing and interacting with the predecessor auditor. I think all in all, the goal of this slide is really just to alert you that your auditors are having a lot of new standards come out in terms of how we need to enhance our documentation, and it may require you all to also be enhancing your documentation or answering additional questions and just being up to speed with what your auditors are being asked to do. Again, the whole point of these is to improve quality across the field in the audit industry. So overall, I think it's going to have a positive impact, but there may be some new or additional things that you will be asked or required to help report. So we did it. We got through a lot of dense material today. Before we leave, I do want to thank each of you for your time, and want you to let you know that Mimi and I are always here to help. Happy to answer any questions that you may have. Maybe something in these slides kind of jogged your memory of something, or maybe a few weeks from now you have an accounting question. Mimi and I are here always to help field those. Please don't hesitate to reach out. With that being said, I'll turn it back over to our moderator, and I just thank you everyone for your time.
Thank you so much to our presenters, Trevor Brown and Mimi Grachek. On behalf of PYA, thank you for joining us. We hope that you can rejoin us shortly for our next presentation of PYA's Summer CPE Symposium, Hot Topics in Healthcare. Have a fantastic rest of your day.
Thank you for listening to this PYA webinar recast. The video recording, slides, and associated material for this and all PYA webinars are available on our website. If you have any questions or if we can help, please contact us at pyapc.com. Thank you again for joining us, and have a great rest of your day.